All right, so we're recording, and what I'm going to do now is, the first thing I'm going to do is to review what we studied yesterday. Okay, so the 28 people or 24 people who on yesterday's call, remember we called GU bullishness, gold bullishness, EU bullishness, EU bullishness. And we said we want to see retracements first, then for price to rally. All right, my voice is echoing. I don't know how to fix that. So I don't know, maybe it's where you're at or something. Or it's your network, probably. I think it should be your Wi-Fi. Okay, cool. So doing a quick review of what we studied yesterday. Remember, the first thing you want to do is to identify your higher time frame support and resistance. Okay, so you want to get your higher time frame levels first. Now, to go back to what I did was I made sure I sent out the first ever video we did. Okay, the first ever session. I made sure I sent that out to people, so that way you don't get any excuses. Okay, so when you join the channel, okay, if you went through the video that I sent, so you're gonna hear me say something like the market always bounces off key levels. Let's see. Voice is funny. I know you change your phone or laptop. All right, better. So you hear me say something like the market always bounces off key levels. Okay, so what the market is trying to do on the smaller time frame. So the goal of the market on the 15-minute, 5-minute, 1 hour, 2 hour, 4 hours is to look for daily, weekly, monthly key levels. The market is always going from key level 1 to key level 2. Okay, that's what the market is always trying to do. So now, I told you that we were still bullish because the first thing you want to do when you come to the market is to look at your DXY. DXY controls all other currency pairs. Okay, yeah, you only saw session 1 because I let you see that. So if you missed session 2 or 3, that's your fault. Now, I know people are actually committed to studying and everything. So those people ask me, especially if I get your message, I'm going to send it out to you on Telegram. Okay, but for the majority of people, until it's over, the 3-week boot camp is over. Now, the essence of this 3-week boot camp is to prepare you guys for 2020. Okay, so many of you guys had goals. Many of you guys came to realization that you could actually work hard and get your shit. Okay, you can actually work hard and quit that job. You can actually work hard and chase that dream lifestyle you wanted to get. So all you needed was the effort and the commitment. Okay, so lots of us, many people here came to that realization 2019. Okay, so now the thing about success is it does not take 1 year. Okay, it's your effort over a period of time. All right, so it's what you keep doing daily. This is why I keep trying to tell people it's what you do each day. That's what counts more than what you do, your success in 1 day or whatever. Okay, it's how you approach each day. Okay, so now the reason why I'm doing this is if I do it this way, it's going to force you guys to want to study. So what I'm doing is I'm teaching you from the beginning, the way I learned it. So now what I'm about to teach you guys in 3 weeks, it took me 7 months to learn that. I spent the first 7 months of 2019 learning all these things you're learning. Okay, so 7 months is a very long period of time. Right, so 7 months to learn all these things you guys are learning, right? So I hope that me giving you guys study days to commit to studying this is gonna make that a habit of yours. So that when 2020 comes, okay, I'll be able to successfully launch London sessions, webinars, live webinars, where we're going to do market reviews and live trading. So it's going to be live trading and market reviews. So I'm going to call out trades live and explain reasons why I'm calling out trades live. I'm still thinking about that. It's not like I'm going to do that or something. Okay, it's not 100% confirmed yet. I'm still thinking about that, but I need to get back to my team. That's Bailey, Norwin, and the rest of them, Matthew. So if it's all confirmed, it's all good to go, then from the third week of January, we're going to do live sessions every, I think 8 a.m. GMT or 7 a.m. GMT. We'll set a time. Now, the reason why is so that when we're talking about concepts, we're talking about things, okay, you guys don't get lost in what we're talking about. And you guys are able to actually teach even other people. So I'm hoping that from this bootcamp, we can get lots of educators to teach people what I'm teaching you guys. So it's the guys who put more effort into doing the exercises, into reviewing what I'm actually teaching you guys. Those are the guys who are going to see success the first part of 2020. Okay, so 2020 is a new decade. Do not take your old habits, your lactose habits, your lazy attitude, do not take that into the next year. Okay, make sure you show commitment, because anything you want to get in this world is yours. Okay, this is why I got pissed, people not attending the webinar when I'm literally doing it free for them. Okay, so let's go back to what I was talking about. Now, the first thing you always want to do when you come to your chart is look at DXY. Okay, because DXY moves all other currency pairs. If DXY is going down, every currency pair is going up. If DXY is going up, every currency pair is going down. So the DXY is the king of the markets. Now, we are the buyers of bearishness in DXY. Now, you might ask, why are we bearish? Because market structure is bearish. Now, can someone tell me the reason why we were bearish in the DXY from this point to this point? Utilizing what I taught you guys the last 3 days. Someone write that down on the chat box. Why are we bearish on the DXY? What can you see from your daily time frame that makes you think, okay, I need to be bearish on DXY? Let's see. Break the resistance, trend, higher low, lower low, lower lows, lower highs. Okay, that's one. It's correct. Shadrach and Ramal, lower highs, lower lows, correct. And Chris actually is kind of correct. Higher low, lower low. Exactly. I need one more thing. Is it actually intermediate high or long-term high? Is it intermediate or long-term? And tell me your reasons why. Let's see. Long-term. So why? Why is it long-term? Seasonal shifts. Okay. Andrew, Andrew, you're kind of way too advanced for this class. Andrew is way too advanced for this class. Always going far. So let's see. The last order block, it was formed, didn't respect the trend anymore. Okay, that's one. 2 lows on each side of high. 2 other highs. Now, what type of high is at the highest point on the chart? What other highs is beside it? That gives you a definition of either it's a long-term high or a short-term high. Okay, actually it was on the second video, not the first. Long-term, middle, then it's medium on the side. Exactly, correct. So now, if you go, I think it's the first video. Yes, the first. If you go back to what I taught you guys the first time, okay, I taught you guys about long-term and intermediate term highs and lows. Why it's very useful for directional premise. Okay, I taught you guys that. So now, if we have an high around, let's see, the market made an high around this level. This high is an intermediate term high. Okay, intermediate term high, another one, boom. That makes this a long-term high. Okay, so if you have a long-term high, where do you think the market is going to go to? long-term low. Long-term low. Okay. That was part of the reason why I said AD was going to go up to take out the daily resistance. Gold, the same thing. GU, the same thing. Okay, because you have a long-term high. Okay, if you have a long-term high, you want to see price go down to a long-term low. If you have an intermediate term high, you want to see price go down to an intermediate term low. It's simple. Okay, that was why I said until 2020 we were bearish on the DXY. The reason why we were bearish on the DXY is because we want to see the market take out this key price swing. Okay, so if I remove everything from the chart, okay, just looking purely at the market, there is a range high here, range low. Yeah, range high, range low. Okay, long-term high, long-term low. So now we have a long-term high, a long-term low. Now, what the market did was the market started to break down. Takes out previous low. Okay, here it traces back up. Now, when the market retraces back up, there are clues as to why we expect the market not to go even further and then drop. Let's remove session breaks. Okay. Remove session breaks. We want to see this. All right, perfect. So put the market around the candle closes. Now, the reason why the market came all the way up, okay, the reason why the market came all the way up is because I told you people, there is long-term trend following traders, okay? There's still fund surpluses. Institutional funds still have surpluses just below this low because you're long-term trend following in nature. Explain that to you guys. Because I have lots of contracts, okay, that you can hold trades for very long periods of time. So you're naturally position traders and swing traders also. What they do is they follow the trend. So now the last major swing low was this low. That tells you obviously there's going to be a lot of fund surpluses just below that low. This is why we want to see the market reach down for that level, because this has become liquidity to the central banks. Okay, it's going to be profitable for the central banks to drive price down there. Okay, perfect. Now we go down to your smaller time frames. Oh, sorry, your smaller time frame. Yeah, your 4 hour, for example. So now you can see clearly the market made equal highs. I told you equal highs to retail traders means resistance. Double tops, double bottoms. This is why we try to correct that notion that patterns, double tops, double bottoms are just like false patterns in the market, just to get you. Okay, so this was an equal high there. What we wanted to see the market do was to take out that high, then most likely drop. Okay, so what the market did was, this was actually caused by the holidays, news, these long spike there. Let's make this X, exactly. So we delete that X. Okay. So the long spike was actually caused by news, but what I told you is you set out a level, okay? Set out a predetermined level where you think price could drop from. So now there's 2 levels where price could actually drop from. Price could actually still go up here prior to this. Price could actually still have gone up there, then drop. We don't know yet. That is why we wait for that extra confirmation. Let's see what price is going to do. Okay. The extra confirmation is, someone write that down on the chat. What is that extra confirmation from your higher time frame level? Remember, the 4 hour is still considered a higher time frame. Okay, so what is the extra confirmation you're looking for the market to tell you, okay, I'm about to change market direction? Touch you people, no, not equal lows, no, not at all. What are you looking for the market to do around this price point? Because that is a sensitive price point. Okay, it's an higher time frame, likely resistance region. So what is the confirmation that you're bearish now? That you're bearish. Break in market structure is correct. Okay, that is what we're looking for. We want to see the market go down. Because all the way here, the market kept making new highs, higher lows, higher highs, higher lows, higher high, higher low, higher high, higher low, higher high, higher low, lower high, higher low, lower high, lower low. Okay. So what I usually teach you guys is, prior to the market getting to that point, where is the last major swing point on your smaller time frame? This is the last major swing point. Okay, that swing point is the last major swing point. Circle that. Boom. Once the market takes that out, that is your confirmed break in market structure. That tells you price is respecting your level, most likely. I told you, it's not actually every time you do this same thing that's going to happen. Okay, but 80% of the time, you're going to be correct. 80% of the time. Okay, so now the market breaks down, suggesting that it wants to go down even further. And what the market did was to drop down, 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 all the way to this level. Okay, then came back up. So now we know, we knew all this was just due to the holidays. It was probably low volume in the market, so the market just had to go down just to seek where liquidity was. Now the market is back on its normal trend, the downtrend. Okay, so this was why we expected bearishness in DXY. Now, if you expect bearishness on DXY, you want to see bullishness on foreign currencies, pound USD, right? So what you simply do is you go to your daily, identify your daily time, sorry, your daily support level. Okay, so you have a range low to a range high, range low, range high. Okay, order flow is clearly bullish because the market is going up. So the order flow is clearly bullish. Okay, so bullish order flow, right? Range low, range high. DXY tells you it's about to drop. So that is all the confirmations you need for pound USD to be going up. So what you're doing is you're going to draw your Fibonacci from the range low to the range high, and it fell around the 786. Okay, now it fell around the 786 in line with support. You could do this as classical support, but for now, I've actually not taught you guys yet about other blocks. So for now, we're going to use classical ICT support. Okay, so we expected around this price regions, want to see bullishness in the marketplace. So now what you simply do now is you go to your smaller time frames and watch what price does. Look at the nature of price around that region. What is price doing? Okay, so now let's watch. Prior to the market going down, so this X, we have lower lows, lower highs, lower lows, lower highs, lows, lower highs, lower low, lower high, higher low, higher high, higher low, higher high, higher low, still higher than 1, 2. Okay, so now you have higher low, higher high, higher low, higher high, higher low. Okay, what I taught you guys Yeah, I think yesterday was that if you have LL, LH, that is the definition of a downtrend. By the time you get HL or an HH, that tells you now HL or an HH around higher time frame support level. Okay, so now the first thing you need to note down is the higher time frame support level. Once you get that, then you start to anticipate the market to give you characteristics of an uptrend from that level. So once the market starts to give you higher highs and higher lows, that tells you you're now bullish. So what you simply do is you keep buying, okay? You're buying, you're buying, you're buying. You want to see price take out old highs, old highs, okay? Equalize in this scenario. That was why we called pound bullishness from this level to here, to here, to this last level. So most likely, I think today is, let's see, today is Friday. All right, so most likely on Monday, price could reach for this level or retrace back down and keep going up. Okay, so now, when you get that shift in market structure, once you get that bullishness, what you simply do is you do the same thing. Price shows you higher high, you expect an higher low. So you simply draw your Fibonacci low to the high, ultimate trade entry. Boom. Trade one. Once price creates a new high, lows to the highs. Price never gets your level, that's cool. Once price gets to a new high, do the same thing. Low, high, boom, you have another one. Okay? So this is why I said you should look to buy GBP USD from this level. Then your TP would be TP 1, 2, 3. So that was why. Simple. Okay, and we're fortunate today to get a very explosive signal to the upside. So the market went explosive to the upside. Now, the same thing I taught you guys applies also to AED. That was why I said AED should be bullish, because we wanted to see DXY bearishness. Okay. Now I told you once price creates new high, you draw your Fibonacci from the lows to high. Okay. Last high, low. Once the market creates a new high, you know that is your setup. Fibonacci from the low to the high. And this setup came around the London kill zone. I taught you guys about the London kill zone 815. So this should have been a classic setup for you. Okay, if you guys are all students, this should be 80 years. It should have been an easy trade for you. So you understand order block. ICT does count the week in fibs. Yes, you can use the Fibonacci. Okay, it does not count the Fibonacci. Sorry, the weeks when during the Fibonacci. Well, I'm using what actually works for me. Okay, everyone has personal preferences. You can decide to use bodies of candles. You can decide to use weeks of candles. It's your choice. Okay, I use both the bodies and the wicks depending on the situation. It's not just candle bodies. Okay, so now back to what I was talking about. You draw Fibonacci from the lows to the high, low, high, boom, and then you have your setup from around here. Actually, I never needed a fib to do this. Okay, I'm going to teach you guys how to ignore Fibonacci and all that. But first, it's essential you guys build your trading skills with Fibonacci. It's very helpful. Very, very helpful. Okay, and I wanted to see the market go up. Go all the way up. Cool. So what other trade? We had gold. Yep. So I actually saw someone says sell gold. I'll check the educator later. So someone says sell gold on I think it was the forum. We're not actually meant to sell gold because there's still equal highs not being taken out. So when it's equalized, get taken out. Sorry, daily time frame. Daily, clean candlesticks body. Okay. Now you could most likely look for the market's drop, but when I see the market go and take out these highs, this is why you would look to buy today, not actually sell. You're looking to buy into equal highs. Okay. Anytime you see the market very near an equal high or an equal low, you best expect that market to tap into it. The reason why is because there's lots of fund liquidity resting around that level. Okay, so what your setup today will actually have been like, let's see, bring out the session break. So if you actually want to trade gold today, knowing the market was very near equalized, what you would have done is once the market creates higher high, the last major swing is here. So you pull out your Fibonacci draw from the lows to the highs, okay? And then your stop loss goes just below. Low, you target equalize, and you're done, okay? Stop loss goes here, target equalize, you're done. Okay, quick for the 5 pips. All right, cool. So what other thing? Oil. Let's see what oil did. Nothing. So there's nothing to do on oil today. Nothing. Well, you could have done the same thing on oil. Low to a high and buy. Okay, still same thing. So what I'm trying to teach you guys is learning how to trust your trend. Okay, that's what I'm trying to teach you guys. Learn how to trust the trend. Stop trying to get the opposite moves every single day. Trust the higher time frame direction. Put your trust into the higher time frame direction. So an exercise I would suggest for you guys is to go back, okay? Go back to your daily time frame, identify your trend, market direction, and go to your smaller time frames. And every Tuesdays to Thursdays of each week, look to do only one action, buy. Only look to buy if the trend is bullish, not sell, just buy. And watch how easy it becomes for you because you're doing just the same thing. You wake up, you're looking for the market to do the same thing. Open, drop into your OTE, then go up, rally up. Simple. So if you did this kind of setup on oil, it would have been around 56 pips. Okay, still profitable. The same thing on oil, the same setup. Once the market creates new highs, you do the same thing, okay? So hopefully that helps anyone. Anyone has any question before we go into today's schedule? Any questions before we go into today's schedule? Let's see. Drop. No, drop down. Chance. Thing called growth first. So what does the fib indicate again? What fib levels do I use? 618, 0.618, 71%, and the 786, 78.6%. Retracement levels. Extension levels is the 127, 121.7, and 161.8. How do you pick your last swing low on the 15-minute time frame? Okay, what I actually try to teach you guys is major low. Okay, major low, and usually your major low is going to be the low of the previous day. Okay, so what was the low of the previous day? That usually is your major low. So I'm going to give you guys an example. Let's use oil. So now if you go back looking at oil, you're going to see the market was just on a steady uptrend. Market kept going up. Okay, so now you notice if you're trying to get setups, The lows were actually the major lows, sorry, the lowest low of the previous day. Now, the lowest low of this day is here, okay? That's the lowest low. The market went up, the market opened, started dropping. So that tells you you're gonna draw the Fibonacci from low, high, get the same thing, okay? The lowest low of this day was here. Drawing the Fibonacci, do the same thing, okay? Low to the high, price if I got there, that's cool. All right, so where was the major low? Major low. So if you actually wanted these here, you could have done, actually I would have opted for this low because this low is more major. This was all just consolidation. So that's really not a good. Okay, so once the market goes up, trace higher, apply a Fibonacci from this low, high, same thing. Okay, same thing. If you actually wanted to draw on today, it would have been this low. Okay, what was the major low of the previous day? You did the same thing. The lows to the high. Market never really quite got there. It's cool. Still the same thing. Right? So let's see. You want to do here, obviously it would be this low to the high. Get a set up around here. Expect the market to go up. But now notice how the market never takes out this high. The market fails to take out that high. That tells you something wrong. Okay, market fails to take out that high. Then what the market essentially did was to come down. Boom. So the market came down. Immediately the market takes out this high. You know you're bullish again. Okay, same stuff. Repeated over and over. So in an uptrend, you're not just going to get slight retracements, all that. Many times a lot of times you're going to get deeper retracements. But usually before the market gives you deeper retracement, there's going to be lots of clues that the market wants to go down. Okay, and there's lots of ways to trade all those deep retracements. But what I want to teach you guys first is to learn how to trust your trend. Trust your higher time frame trend. Okay. So let's see. Let's go to today's schedule. 1840 EMA. So now, all right, guys, bring out your notepads because you're gonna take down notes. So basically, we determine the trend from daily time frame and go to the hour time frame. Exactly, correct. Tigers only. What indicator do you use to break down the marker day by day type of scotch? All right, so if you're using TradingView, what you simply do is you go to your settings. Okay, go to settings and click or unclick session breaks on TradingView. Let's see if you say, yeah, so click or unclick session break. So that divides your charts into the different days. Session breaks, no session breaks. Hopefully that answers your question. Now, let's go back to DXY. So what I want to teach you guys is using the moving averages, okay, to determine institutional sponsorship. So now, if you guys don't know what institutions are the people, the guys who move the markets, the people behind what you see on your screen. Those are the institutions. Okay, they're the ones who control these your typical bullish candle, bearish candle, where price moves, all that. Okay, so you're usually behind the major moves in the market. You're essentially the owners of the market, let me put it that way. Because without them, there will be no Forex. These are the institutions. So now, who do they comprise of? Majorly the central banks and all other people associated with central bank. For example, the Aussie dollar is being controlled by the Bank of Australia. Okay, British pound being controlled by the I don't know what it's called in England, the Bank of England, I think. Yeah, the Bank of England. The euro is controlled basically by the EU. Okay, so I don't know the name for the EU. Probably it's the one in Switzerland. So like that. So all different currency pairs are controlled by the central banks or the governing bodies of those currency pairs. These are the institutions. These are the people who call the market makers, the dealers, institutions. Okay, because you're the ones in charge of price. Okay, they're the ones in charge of price. Now, I want to show you guys how to determine what direction you're trying to move the market using the exponential moving averages. So the first thing I'm going to do is to go to settings, indicators, and type in EMA. I'm going to click this 1, 2, 3, cancel. So the first one is settings, take this to yellow, right, okay. The 2, take this to red, which is red, make this sequence 2, and then you type in 18, 9, 18, and then finally last one 40. So 9, 18, no, time is low. 9, 18, and 40 EMAs. Let's make this dark blue, very big 3. So 9, 18, 40 EMA. Okay, and by the way, if you guys are writing all this down, the EMAs are the 9, the 18, and the 40 moving averages, exponential moving averages. Okay, and you're only using this on your daily time frame. This strategy I'm giving you guys is purely for market direction. If you're unsure about the market direction, this is what you look at. Okay, I don't actually really use this, but this is what I'm trying to teach you guys. Okay, you guys are still new, basically. So use the 9, 18, and the 40 moving averages. Okay. Oh, the EMAs, exponential moving averages. Exponential moving averages. So you go to your indicator bar on your trading view, click that, just type in EMA, and you click that 3 times. Okay, moving average exponential. Type that 3 times, that gives you 9. Then what you simply do is you go to the left, click the icon that looks like settings, okay? Click that, then you change input on the upper to 18, the first one, the second one to 40, and change colors to differentiate them. Okay, so that gives you the 9, 18, and the 40 EMAs. Now, this is solely for your daily time frame, to get your daily time frame bias. When your 9 moving average crosses with your 18 moving average, that tells you there's a trend change. So now I'm going to give you examples. Look at all the time the red and the yellow crosses. So the 9 is the yellow, the red is the 18. Okay, so cross here and here, okay, crossed here. All right, so it never crossed until got all the way to this point. So on this small this small piece of data, the market, the 9 and the 18 EM is crossed only 3 times. Okay, so now when the market crossed here, this is where the EM is crossed. The first time, second, and then the third time. Now look what happened after the EM is crossed. Okay, so now the market crossed, the 9 crossed over the 18, and market basically went up. The market never changed trends until it crossed again. Okay, So when the market crossed, before people even knew that, okay, this is a shift in market structure, blah, 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 the EMAs crossed around this level. So right from here, you could be bearish. Okay, you could know that the market is going to keep going up. Now, there's a slight retracement in the market, a very deep retracement. That's fine, it's okay. Now, you're not sure, probably, until this EMA crosses right at this big candle. That tells you, okay, now you're confirmed bearish. Notice the 9 EMA never goes above the 18 EMA. Okay, that the 9 and the 18, the 9 and the 18 EMAs crossing on your daily time frame tells you that there is a trend change in play. Okay, so write that down. 9, the 18 is used for trend changes. Okay, and you guys could go back and do practice on any pair with the 9, the 18. So once it crosses, watch how the market reacts to the 9 and 18 EMA crossing. Okay, so now the 9 and the 18 EMA crosses. Now, when the 40 and the 18, the 40 is the thick blue line. Okay, once the 40 and the 18 starts to fan out, once it starts to expand, that tells you there is a very strong institutional sponsorship behind that move. And what you're often going to get is a very explosive move. Explosive moves one direction. Okay, so right from here on to this point, the market ran up explosively because the red and the blue were starting to spread out. So they started to spread out. That meant the market moved up very, very explosive. Okay? So does this make sense to anyone? Any questions so far before I go to the next segment? So we look at other examples. Let's see. No questions so far. Cool. GU. We're gonna do the same thing on other pairs. Okay. So now, where did the 9 and the 18 EMA cross? Here first, crossed here. 1, 2, go down. Let's look at, so it never crossed until, right? So we have 1, 2. Okay. So it crossed up and once, twice. Okay, now notice the market started to explode once the red and the blue started to expand. Okay, the red and the blue started to expand and the market became explosive. But right around this region here, there's really not much really like real price movement. And then the red and the blue were basically just dancing around. Okay, they were dancing around. Dancing around means the institutions are adding more positions, adding more long-term positions. This is what the EMA is used for. Okay, so the EMA can indicate when the institutions are stacking a particular position or are about to explode. So what basically makes the market explode is due to the institution stacking just one position. In this case, buy. Okay, so 1, 2, we're very, very tight around this region. Very tight. Now, around the first vertical line, that tells you the market has changed direction. Now, notice how the market, the yellow never crosses the red right from this point when the market came down. Okay, so all the way from here, let's see where the market crossed, here until this point. The yellow never crossed the red. Immediately the yellow crossed the red, the market changes direction. And then the next clue, like I like to teach you guys, is the break in market structures. Simple, confirmed. Okay, so those are all subtle clues. This is where the EMA helps you out in market directions. Now let's see. Expand as it go away. Yes. So when the 40 and the 18 start to separate from each other, that is when you know the deal has been done. You're going to get explosive daily moves, explosive daily ranges. Okay. Do you draw on key levels? So what do you mean by key levels? Expand as it go away from each other, yes. And when the 9 and 18 cross each other, trend change. Exactly. Once you see your 9, only on your daily time frame. Okay, only on the daily. Once the 9 crosses the 18, that is trend change. Okay, key levels mean daily support resistance. All right, so there's lots of ways I use key levels. Key levels means different things to me. I mean weekly order block, daily order block, fair value, okay, equilibrium, all those stuff. So we're gonna get to the key level part later, okay? What I want you guys to get is the directional bias. So now, notice what happened just today, okay? Just today, sorry, 2 days ago, GU crossed to the downside here, okay? But immediately the market crossed the downside, it went up. Okay, it's about to cross again. Okay, and notice how the blue and the red are still far away from each other. So it's still not very certain if this is going to be a downtrend or an uptrend. Although I know the market direction right now, but using the EMAs. Okay, so the 9, 18, 40. Any questions so far before we move to the next segment? Because we have lots of things to cover. Institutional levels. Okay, yeah, I actually do use institutional levels. Now, like I told you guys, the market, basically every major market shift happens on institutional levels. Every. Okay, so let's do this. Let's remove all drawing tools. Drawing tools. Every major market shift happens on institutional levels. I don't know if I could actually get the institutional, let's see, institutional levels. No levels, actually. Institutional levels, not the round figures. Okay, round levels. Let's see that. Let's see what that is going to give. So what the heck is this? What the heck is this? This is all crazy. Come on. All right, so I'm going to do this all manually. Alt H 1.2 thousand. 1.2 thousand, boom, done. K 1.22 thousand. Oh shit. 1.22 thousand to 200. Okay, let's see. 1.2800. Oh, he cleared this up. Okay, 1.2 thousand. Okay, 1.2800. 800. Boom. Okay, done. What else? 1.29. Alt H. Boom. 1.2900. Okay, perfect. All right, so now notice how all the retracements fall on round numbers. 1 falls on round number, 2, 3, 4. If you go to any pair, it happens every single time. All levels falls on institutional levels. Told you institutional levels are the natural support and resistance in the marketplace. Okay, automatic quarter theory. Let's see. Automatic. Yeah, I think this is so what's gonna happen. So what's actually going on? Let's see. No, not disable hours. Disable colors. No. 20. Let's see what happens. 50. O-level materials. I don't even understand what's going on. No, I'll figure all this out. But thanks. What are all the institutions? Okay, so the institutional levels are the main institutional levels are the round figures, that's zeros, and the mid figures, the 50s. Okay, 1.2950 is an institutional level. 1.2900 is an institutional level. Major institutional levels. And the lesser institutional levels where the smaller time frame reversals happen around at the 60s, 70s, 80s, 20s, all those ones. Okay, the round numbers. I explained to you guys the reason why the market reverses around round numbers, because it is actually computers that moves the market, and the computers likes to move the market around round price numbers that is easy for it to compute, because it's moving around lots of contracts, lots of different inputs. So it needs to do that around logical price numbers. This is why the market likes to reverse around key levels. Okay, key levels. 1.2980. Okay, the same thing every single time. 1.35, the same shit. Okay, so that's all with institutional levels, and we're done with the EMAs. The 1918 has to cross over for you to know, indicate to you that it's a trend change. Then the 18, the 40 needs to fan out for you to understand that just the move is starting to be explosive, and you're going to get bigger daily ranges. So the daily ranges are going to be bigger. You're going to get more explosive moves to the upside. Okay, so now I want to teach you guys something. For those of you guys who are not really exposed to this, how you can know the market is going to reverse before the market even does that. Now, I'm going to teach you guys in terms of institutional investments. Okay, so now what is actually making the market move is money. The market moves based off where the money is. Okay, where is the money is where the price data feed is going to go to. Okay, now there's things called seasonal tendencies and SMT divergence. So now I know lots of you institutional traders like to ignore what seasonal tendencies are. So what I actually did after studying seasonal tendencies, this was recently, was I charted it back DXY, EU, gold, G8, GBP all the way back to 2000 and I think 2007 or 6. I spent actually about 1 week thinking that it was crazy. So I was so desperate trying to get the seasonal tendencies. I actually knew what the seasonal tendencies are. I was trying to prove if it actually worked. And every single year except 2012, it all worked. Okay, sorry, 2014 it actually worked. Everything kept playing out the same way. Okay, so that says seasonal tendencies is correct. And there's a reason why seasonal tendencies actually happen. So now, seasonal tendencies, the market always has a tendency to change direction every 3 or 4 months. That's every quarter of the year. The market always has that tendency to change trends. Okay, but in a year, it happens about twice a year. Okay, so typically what you're going to see is the market is going to it's going to make the high for the year around March, April on euro and pound. So make sure you guys are all writing all these dates down. It's very vital that you guys write all these dates down. So around March, April, May is the most likely time for GU and EU to form the high of the year. And the market is going to start to drop around this period. Then around August, September, you're going to get a bullish reversal in the market, oftentimes. Okay. All right, I'm going to repeat it again. Around on pound and euro, during March, April, May, that is the most likely time on the macro time frame, macro perspective, for you to get the high of that currency pair. Okay, then going to the rest of the months, the currency is going to drop for about 3-4 months. Then towards August, September, it's going to be a reversal of bullish, and the market is going to go bullish for a number of months. So now let's look at an example. This is actually 2019 GBP USD. Now, the high prior to the market going up to this level, the high of the year came around March. Okay, I told you guys the high of the year is going to come around March, April, May. Okay, so we had the high of the year around March. Then the market dropped for 1, 2, 3, 4, 5, 6. So the market dropped for 6 months from March going into the what's it called? I think the summer months. So typically around summer is when you're going to see foreign currencies rise. During summer in the US, foreign currencies are going to rise. Okay, go bullish. Around March, April, May, that is when most likely the foreign currencies are going to drop. Okay, so hopefully everyone gets that. Now, if you go back to previous years, the same shit happens. Right, so let's go to 2018, January 2018. Boom, boom, boom. The high of the year comes around April. Boom. Seasonal tendencies. Okay, seasonal tendency 2017. 2017 was actually a corrective. The market totally went bullish. Okay, so the market was bullish, but around May there was still bearishness. Okay, even in a bullish market, so there was still bearishness around May, but around August, September, it made a major low. So even in bullish markets, around the summer, you're most likely to get a major low going into the end of the year. Now, the same shit happened on 2018, right? Around August, major low form. Market rallies for about 2 months before it continues to downtrend. Okay, let's do for 2017. Let's see. Now, what I'm going to do now is I'm going to teach you guys how to utilize all these into your trading. So 2017, the same thing happens. The market is crazy high around April, May. This is actually due to news. So high comes in April, May. Low comes in around October actually. So the 1st of October, end of September, the market goes bullish from the end of the year. The same thing keeps happening, okay? So now we know seasonal tendencies is around March, April. That around March, April, May, that is most likely for GU to create the high of the year. And around August, September, going into October, that is the most likely time for GBP USD to create the low of the year. Okay, cool. Now, let's talk about USD SMT divergence and how this could actually help you, okay, get your macro direction. So now, if you guys have actually been on SMT, I told you DXY was going to go bearish till 2020. I said GU was actually going to go bullish till 2020. A was going to keep going bullish till 2020. So we called out the bullishness of all these currency pairs before they even happen. Okay, I want to show you guys what we did. We called out GBP USD bullishness from here. Okay, called out DXY bearishness from here. And we said the market was going to go bearish until the end of the year. So delete that. So that is, if you think about that, it's actually a very crazy precision, very crazy precise way of trading. Before anyone else even knows the market is going to change trends, we already know where the market is going to go to. So myself and Bailey, okay, Bailey is one of my students, we called DXY bearishness from this level, and we said DXY was not going to reverse until it takes out this level. Okay, so it was not going to reverse until it takes out this level. Now, the reason why is because this is called USDX SMT divergence. I'm going to write this out for you guys so you guys understand what I'm talking about. Divergence. Okay, so now when DXY is going up, this is normal correlation. When DXY is going up, higher highs, higher lows, higher highs, higher lows, higher highs. Okay, Euro USD should be doing this. Lower highs, lower lows, highs, lows. Okay, GBP USD should do this. Now, someone told me why these are inversely correlated with what I've taught you guys the last 2 days. Okay, so from what I actually taught you guys the last 2 days, tell me why when DXY goes up, E should go down, G should go down. Why? Taught you people. Let's see. No replies yet. Taught you guys yesterday. I repeated it yesterday. I taught you guys 2 days ago. When DXY goes up, why do you want to see EU go down and GBP USD go down? Let's see. GU, EU. So because USD equals DXY exactly. Dollar result. USD is versus the foreign currency. Exactly. So dollar is king. If DXY goes up, everything goes down. Okay? If DXY goes up, everything with DXY goes down. GBP USD goes down, gold goes down, AED goes down, NCD USD goes down, Euro USD goes down, USD CHF goes up, okay, USD JPY goes up, USD MXN goes up. The DXY is going up, okay, everything else goes down. That's the way the market works. This is where you get your risk on and your risk off scenarios. I taught you guys 2 days ago. Risk on, DXY is bearish. Risk off, DXY is bullish. Okay, simple. That is always the first thing you need to do. Yeah. What about US 30? Well, okay. So I'm going to cover US 30 is actually kind of an exotic. So I'm going to cover US 30. So US is coded pair in EU and G. So when it strengthens, the others goes down. Exactly. Does it depend on DXY? Yes. Everything. Bitcoin depends on DXY. G depends on DXY. AD depends on DXY. Anything being traded in the market depends on the DXY. Okay. Everything is affected by the DXY. The stock market indices are affected by DXY. Nasdaq is affected by DXY. Dow Jones is affected by DXY. Everything is all correlated with DXY. The DXY is the king in the markets. The DXY moves, every other thing moves. Okay, all right, so Bitcoin has USD in it. BTC USD. Okay, that tells you what's going to happen. BTC USD. So if DXY is making a serious drop, what do you think is going to happen to Bitcoin? Rally. Okay, so now let me blow your minds more. So now you know why people are calling for the cryptocurrencies to go up. So Bitcoin is actually kind of like the DXY for cryptos. Okay, that's the biggest market cap on the crypto market. Okay, so now people are saying invest Bitcoin, blah blah blah. The only time you're really going to see the value of Bitcoin skyrocket is when you probably get a US economy meltdown, which will cause DXY to drop. Once DXY starts to drop off, you're going to get a serious kick in cryptos. Okay, because Bitcoin is going to go up. If Bitcoin goes up, the other currencies are going to go up. Ethereum, XRP, the rest of them. Okay, the same way DXY affects currency pairs, the same way Bitcoin affects currency pairs. So if the DXY is dropping seriously, okay, that is a basic devaluation in fiat currency, because DXY is the symbolism of fiat currency. Almost all international transactions in the world is done in dollar, okay, which is DXY. So if DXY is seriously dropping in value, that tells you fiat currency is dropping in value. And if fiat currency is dropping in value, there has to be a flight of investment to another asset vehicle, which is either gold or cryptos. So that settles everything for investments, all that. Do I keep track with 30-year, 10-year, 5-year? Exactly, I do that. So you actually saw me looking at all this stuff before I started the webinar. This is where I look at the 10-year treasury notes, 5-year treasury notes, the US treasury bonds, and all of that. Okay, all around this region. So that's going to be like a special class, because this, out of everything you're going to learn from ICT, this is the most complex thing you're ever going to learn. Utilizing the treasury bonds, 10-year T notes, all that. Okay, TOT, open interest, all those things are very complex stuff. Okay, but for now, I want you guys to understand USD SMT divergence. Okay, it's very easy to get. Now, if the SI goes up, EU has to go down, GBP USD has to go down, because when the DXY is going up, that is a risk-off scenario, meaning there's going to be lots of investment into the DXY. If there's going to be a flock of investment into the DXY, then there needs to be a flight of investment away from something. So that something is the foreign currencies, symbolized by the pound and the euro. Okay, so if DXY is going up, pound and euro has to drop, because investment is being moved from that asset vehicle into the DXY, that's dollar. Okay, if the DXY is going down, okay, the other currencies needs to go up. That is a risk-on scenario, meaning the base currency of the world has a risk in it. So there's risk in the marketplace. What's going to happen is there's going to be a flock of investment away from the risky asset, which in this case is the dollar, the DXY, into euro, foreign currencies, which are less risky asset vehicles, and pound. Does this make sense to anyone? No question so far. Okay. Right, perfect. Yeah, if T notes are going up, DXY goes up. If T notes going down, DXY goes down. It's positively correlated. All right, cool. So when the DXY goes up, in summary, when DXY goes up, everything should go down. EU should go down, GBP USD should go down. But now, okay, I want you guys to pay attention now. Now, if the DXY is going up, okay, and either GU or EU is going up at the same time. Okay, listen again. If the DXY is going up and either EU, the foreign currencies, or GU is going up at the same time, that tells you something is wrong. Something is seriously wrong. And what is wrong there is asset or money is being moved from the DXY to either the foreign currencies or from the foreign currencies to DXY. So this is how you can know, even before any other person else in the market knows when there's going to be a trend change. And not just a simple trend change, a major trend change. Okay? This is going to blow your mind. Okay, it's a major trend change. So once you see a break in correlation between the DXY, if either EU or GBP USD is doing the same thing as DXY, that tells you something is wrong. You never want to see DXY creating higher highs and higher lows, and either GBP USD or Euro USD creating higher highs and higher lows. If one of them is creating higher highs and higher lows, know that there's going to be a trend change. The trend is going to change. Definitely, the trend is going to change. Okay? On your daily time frame. So now let's watch. Go to reset charts. Boom. Now, from September 1st to October 1st, DXY went up. Higher highs, higher lows. Okay? What we actually do is we remove everything else except for, let's add EU to that. Euro USD. No, USD. Overdrain tools, add to watchers. Okay, so now DXY went up from September 1st to October 1st. Euro USD, what do you want to see Euro USD do? So let me ask you guys this question first. If DXY is going up, higher highs, higher lows, what do you want to see EU do? Let's get your responses. That way is going to stick. You want to see EU go down, lower highs, lower lows. Exactly. So now let's see what Euro USD did the same time frame. Euro USD did exactly the same thing you said you wanted to see do. When lower highs, lower lows. Okay, cool. Now, if Euro USD is making lower highs, lower lows, what do you want to see GBP USD do? Okay, what do you want to see GBP USD do? Let's get responses. Same, bearish, exactly. So you want to see GBP USD do lower highs and then lower lows. But September 1st to October, GBP USD never made lower highs and lower lows. Okay, the same time period, Euro USD was going down. Okay, GBP USD was going, sorry, Euro USD was going down, DXY was going up. Pound USD went up. So now pound and USD were correlated with each other, which is not supposed to happen. You're not meant to be correlated with each other. So if DXY is going up and pound USD is going up, best expect that one of them is going to change direction, and DXY went down right at this point. So this was how we're able to call bearishness in DXY. Okay. If you go back even further, go to, now remember it all falls in line with your seasonal tendencies. The seasonal tendency around August, September, October for foreign currencies to be bullish. Okay, it's how all these all lines up. Seasonal tendencies for these currencies to be bullish, you get a USDX SMT divergence. That is the all-in-all confirmation you need. Everything that you need. How do you know which one is going to trend change? All right, cool. So if what you need to do is watch what the other one is doing. So if DXY is going up, E is going down, okay, and G is going up. What's going to happen is DXY is going to confirm, it's going to change direction. Then E would confirm to what GBP USD is doing. Okay, so in a situation where the DXY is going down and GBP USD is going down, but EU is going up, then DXY is going to change. So the only thing that's changing is the DXY. Once you get something, once you see the market, either DXY or EU or DXY or GBP USD go the same direction, basically, the DXY is going to change market directions. Okay? So if DXY was going up, DXY is going to go down. If DXY was going down, DXY is going to go up. Simple. Hopefully that sells that for you. Between G and DXY. If it's between G and DXY, same thing. DXY is going to change direction. EU and DXY is going to change direction. So delete that. Delete that. So let's look at more examples. More examples. Set chart. Let's see. January 1st, GBP USD goes up. Okay, let's see Euro USD. January 1st. It's exactly. Now, this is another perfect example. Down. So from February to mid-March, EU goes down. But from February to mid-March, GU goes up. Okay? So one of them is doing the same thing as DXY. 2019, boom. From February to mid-March goes up. Okay. So from February to mid-March, DXY is going up. From February to mid-March, GU is going up. From February to mid-March, EU is going up. Sorry, EU goes down. So GU is doing the same thing as EU. One of them has change. Now, seasonal tendency tells you March, April, May, EU, GU needs to be bearish. So what does that tell you? What does that confirm to you? I want to see someone respond to that. What does that confirm to you? That you're going to see what? Seasonal bearishness or bullishness? Seasonal bearishness. Right. You're going to see seasonal bearishness. So the market around that season is going to drop until August, September, October. July, August, September, October, around those 4 months. So you could best expect the market is just going to keep going down. And now you have one direction. Now that you have that one direction, what do you want to do every single week? Every single Tuesday, Wednesday, Thursday? Sell. So you have one direction for month on end. The markets give you one direction for month on end. So that way you become a millionaire just doing the same thing. Doing the same thing. Okay? Simple. So there's lots of examples. So I've gone back to 18, 17, 15, 16. There's lots of examples where this all happened. Okay, so what I want you guys to do is to go back and do the exercise. I don't want to give you guys everything. Okay, so the knowledge comes in you guys doing the exercises. Because this webinar is actually going to be a waste if you guys are not doing the exercise. Okay, and sorry, I made a false statement. So I just said there, you just feed off the trend exactly. So you just do one direction. The market is doing the same thing. So you're even getting your trend changes before any person else knows, okay, the market is now bullish. Okay. So I actually want to say something. Let's see. Yeah, the exercise. So you guys go back to the exercises on seasonal tendencies and trend changes. So seasonal tendency for the foreign currencies to drop around March, April, May. So now, if you want to see the foreign currencies drop around March, April, May, that tells you that is the most likely time for DXY to create the low of the year and then rally. Okay. So around March, April, May, you want to see DXY rally. At the same time, you want to see EU, GU drop. So around that time, you can most likely expect a USDX SMT divergence. Now, if you use the same thing on your 1 hour time frame, 4 hour time frame, well, that is a more complex class. Okay, that class is scheduled for I think 2 weeks time. So, but this is how you can basically use to get a one direction in the market. So you have just one direction, you're doing the same thing. Okay, one direction in the marketplace, you're doing the same thing. Coupled with the fact that I taught you guys about intermediate term swing guys and swing lows, long-term swing guys and swing lows. That tells you if you're getting this divergence on pound USD, you best expect that this low is definitely going to get taken out. Okay, so if you're getting an entry from there, you could hold that trade until the market takes out this low, which eventually happens here. You can swing that trade. Okay, the same thing. If you get USDX XMT divergence around this level, you better expect the market is going to take out this side. Okay, because the market deals with ranges. And the final piece of the puzzle, okay, this came at higher time frame support level, weekly support level. Okay, there was a weekly support around this level. USDX SMT divergence in line with seasonal tendencies all reasons why you need to be bullish one direction in the market. And watch what happened in GBP/USD. The market just kept exploding up, exploding up, exploding up. Okay. So the person who actually taught us the strategies and everything, ICT. Okay. So everything is all credited to ICT. He was actually able to get the trade from here, and he held that trade until this level. He said he was actually going to get to this level. Got there for about 1,400 pips. Okay, actually, I was actually able to get an entry around this level, but I held to around here. I held to around that level, then got another entry from there, also around this level. So this is the last leg in price. That was the painful part. That last leg in price. Okay, but lots of people were able to swing this trade onto this level. So it was a very phenomenal trade to catch. Very, very phenomenal. Yeah, I think next year is even going to be more crazier. Okay, so far I taught you guys about the 18 EMA, 40 EMA, 9 EMA, seasonal tendencies, USDS, SMT divergence. Okay, so now if you guys notice the way you guys have been taught the last couple of days, I'm teaching you guys on the bigger time frames, the daily, weekly, how to look at the market in a macro perspective. Looking at the market in a very, very macro perspective. Okay, so what I'm trying to do is to solidify your higher time frame skill set. Once your higher time frame skill set is solidified, then smaller time frame is going to be way easier for you because you're going to know what you need to do. You're going to have a bias in the market every single day. So every day of the week, there's going to be a bias. Okay, every day of the week, you're going to have just one bias. That makes things very easy for you because you know today I want to buy, tomorrow I want to sell, next tomorrow I'm going to buy. Okay. But all people are still figuring out, let me draw my Fibonacci, let me do this, let me do blah, 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 let me do that. You already know what's going to happen. And you're just going to keep doing the same thing, week in, week out. Before you know it, become, boom, you want M. Okay? That's because you put in the effort, you attended the webinars and everything. This is why it's very vital that you do your own exercises. You do your exercise. Okay, that way you see the same thing and then you learn to trust what you're seeing. Okay, exactly. Yeah, bro. So you learn to trust what you're seeing in the marketplace. Now you develop a higher time frame bias. You can now take that into the 4 hour, the 1 hour, the 15-minute time frame. You're going to do the same thing. So now, if we know, let's actually do a live charting that. Okay, so now we know around the same period while EU was going down, DSO was going down, GU was going up. So we know from around this level, the market is going to rally. Okay, from that level. Around here, I want to see the market go up. Now, I taught you guys, if you have a very long week, you ignore that week. Okay, so this week was a very, very long week, but 109 pips. So this is why I told you guys, really Fibonacci is actually very subjective. Sometimes I use the weeks, sometimes I use the bodies of the candles. So what I'm actually going to do is I'm going to take the body of this candle, move it up here. Okay, falls between my 71 to 786. That is where I want to see. Okay, so now I go down to the, let's use the 15-minute time frame. Let's see if we can actually get that. Perfect. Settings, bring out session breaks. Okay. Minimize, minimize, minimize. Boom, boom, boom. So from around this level, we want to see bullishness. Around that level, we want to see the market go up. Okay. So we're looking for the market to go up. Once the market shows us it wants to go up, we're going to do just one thing, buy. Okay, just one thing, buy. So let's see, looking for a break in market structure. Small time frame. This is actually very nice. So what's going on? This is very slow, very, very slow. So I want to see the market do something. Take out an eye, then we're gonna buy. Exactly. So the market takes out that eye. Okay. We're looking to buy there. So that is where we're buying. Buying the market from that level up. Okay, up. Hopefully the market is not taking it out. So low, up. Okay. Let's see. Okay, go. Okay, market still respecting. Let's see. Respecting. So every time the market takes out a new high, took out old highs, I'm gonna set out to that level. Entry 2, let's see, entry 2, there. Entry 1 is there. Entry 2, around that level. What's actually happening? The market is slowing down. So, oh, so I think something went wrong. Oh, what's going on? Okay. Oh, missed a level. Fuck. Went up. Crazy. Old eyes gets taken out. Every single retracement we're gonna buy. Retracement we're gonna buy. High to low. So I think around this level, buy again the market to that level. So we're gonna buy from that level here. Exactly. Perfect. Almost perfect around that level. Market keeps going up, goes up. Using the same thing I'm teaching you guys. Just one direction. Focus on one direction. Goes up. It's just the 1 hour time frame actually. So let's make this easy. So the market keeps doing the same thing. What you're just doing is you're buying on Tuesdays, Wednesdays, Thursdays. So I'm going to tell you guys why we buy on Tuesdays, Wednesdays, and Thursdays. When buying a retracement after high is broken, where do you typically put SL? So there's lots of ways to put SL, okay? Many times I love to use 5, 6, 10 pips SL and stop losses, but normally it's just 30 pips, okay? So if price tags you out by 30 pips, most likely you're wrong. Now, the reason why I'm saying most likely you're wrong is because the average daily range of most currency pairs, the most volatile currency pairs, I'm not talking about gold or oil, the average daily range is about 30 pips. Sorry, 100 pips, okay? So now, due to the timing of when you're entering a trade, okay, due to the timing, the market should not tag you out by 30 pips. If the market tags you out by 30 pips, then you're wrong. Your directional bias for that day is wrong. Okay? Now, there's lots of ways you could narrow that down to 15, 10, 7 pips. Screen is blurry from your close connection. This is GBP USD 1 hour. So how do you set your SL on the 15-minute time frame? We're going to do SLs later. Okay, we're going to cover all that. I need to teach you guys about order blocks and all those stuff. And I think Bailey's going to cover order blocks and fair value gaps. I think Bailey is going to do that because Bailey's very, very good at it. Very good. So now we had market value up, took out orders. And what we're going to keep doing is each time the market creates a new high, we're buying. So now, for example, in this case, there was an old high here. The market broke that up. Sorry, we took that out. Okay, low, lower high, lower low, higher high. Then you simply pull out your Fibonacci and do the same thing. low to high. You're looking for the market to take out this side. Now, the reason why you're looking for the market to take out that is because you know the market is bullish. So it's safer for you to buy than for you to sell. Okay, the reason why is obviously because institutional sponsorship is bullish. So you want to trade the direction, okay? You want to trade the direction the Bank of England is trading and the US Federal Reserve is trading. So what I'm teaching you guys to do is to learn to trust the banks, learn to trust Bank of England, learn to trust the Federal Reserve, because they're the guys who know what is up in the market, okay? And every other person is just sheep trying to play their own game. So learning to trust the higher time frame direction is you learning to trust the big banks, the commercials, institutions, okay? So once the market takes out this side, you're gonna do the same thing. Takes out that eye, low, high, the same thing, the same entry. So you have 1, you have 2, using the same principles I'm teaching you guys. Okay, simple stuff. Market creates a new high, do the same thing. You keep doing the same thing until the market makes a lower low. Okay, then you can start expecting. So now, what I'm teaching you guys, you're obviously gonna lose. So definitely, at one point the market is gonna create a lower low, okay, a lower high for a very deep retracement. What I'm teaching you guys is how to be on the winning side most of the time. There's lots of ways you could avoid the market tagging you out, creating lower lows and all that. But for now, this simple thing you're doing, identifying the daily time frame direction and just trading in line with that, that puts you at a spot 80% of where most people are not. Because most people try to do lots of things, trend line breakout, MACD crossover, stochastic crossover, plus 8 different indicators crossing over to the point where you're looking at indicators now, longer price actions, all those crazy rubbish. Okay, the only indicator I gave you guys was the EMAs. You don't really need the EMAs. You don't really need the Fibonacci. You don't really need anything. The only things you need are horizontal lines. Okay, and in 3 weeks' time, I'm trying to take you guys to that level where the only thing you're gonna need is just a line. Okay, just your line, the price, the time, because that's the only thing that matters in the market. The only thing that matters in the market is your line, time of the day, time of the week, and the price. Okay, that is the goal for everyone. For you to get to that goal in 3 weeks' time, you need to put your effort into doing the exercises. So your exercise for today is go back in the past, identify the times where EU and GU dropped around March, April, May, rallied around August, July, August, September, and if it doesn't happen around July, August, September, most likely October. Okay, because around those months, you're going to get bearishness, March, April, May, bearishness on EU and GU. And July, August, September, going to October, you're going to get bullishness on EU and GU. And the inverse is going to be for the DXY. And also around those time periods, you're going to be looking for divergence to confirm that it's about to happen. Okay, USDX SMT divergence. GBP USD, EU USD has to go the same direction. Once one of them is doing the same thing as DXY, there's a crack in correlation. The market is going to change. The market is definitely going to change. The market is 100% going to change. 100% going to change. From everything I've done, it's never failed once. So the market 100% is going to change. Okay? And once you get that, you're good to go for the next 3 months. The next 3 months, you have one direction. You're going to keep doing the same thing for that next 3 months. Okay? Week in, week out, you're doing buying, or selling. Okay, so hopefully this webinar was helpful to you guys. And this brings us to the conclusion of this webinar. So you guys all have a wonderful day, and I'll see you tomorrow.